Welcome back to the Everything Property Podcast. Today's guest is crushing it. He's accumulated a total of 14 properties in his portfolio, but has a really interesting update on that he'll disclose in the podcast, and has close to 10 years experience in the lending space, split between both banks and private lending, and even in his first year of private lending, wrote $135 million worth of loans. He averages about 10 self-managed super fund loans for clients a month. So who better to get on the podcast to talk to us about that particular topic? Mr. Nick Wilcox, welcome to the Everything Property Podcast.
Thanks for having me.
All good. Look, welcome on. And I guess for the people at home that don't know you and don't know your story and haven't done the research like me, I'll get you to tell us a little bit about you. But before we do that, the foundation that we're on for this podcast is about investing strategies. One of the strategies that people may want to do is investing in their self-managed super fund. So I thought, you doing the volume of self-managed super fund and having bought in your own portfolio within your self-managed super fund to get you on to talk about it. So that's why you're here. But before we jump into that stuff, tell me a bit about yourself and qualifies you in the space.
So I started, I think when I was 20 in finance. I worked for an equipment finance company for 8 years. We did equipment finance for like fit outs for restaurants and gyms and all small business stuff. I always wanted to work in the bank, but at that age I think I got knocked back from Westpac when I was 20, and the recruiter goes, go work for this company. So I went and worked there. Got a job 8 years later at St. George, worked there in small business lending for like 6 years. We did home loans, commercial property purchases, and then St. George and Westpac at the time were the biggest super fund lenders. They dominated the space. So at my time in the bank, I did hundreds of super funds.
Wow. Okay, great.
And then St. George stopped doing them. Can't remember. It was maybe 2020, maybe. So it was a.
Why did they stop?
There's rumours about risk or like cost of funds, but I don't know.
Just didn't have the appetite for it anymore.
A lot of the banks started to pull out. NAB, ANZ, Macquarie, everyone started to pull out, and then now the second tier lenders dominate. But yeah, after St. George, while I was at St. George, I built a lot of relationships with brokers, and one of my largest broker used to introduce me a lot of business. He offered me a job. So in 21. We're at 21. I transitioned, so it's been 2.5 years now. And
during COVID, then.
Yeah, so it was July 21. So I resigned. I had a baby. My wife had a baby. And started a job. And then we went into COVID lockdown. So for my first 3 months as a broker, I was at home. Couldn't leave the house. So it was good.
What was the trigger for you to leave the bank? You've been there for a long time. You're doing a lot of like varying work between properties, finance, self-managed super fund. What was there a particular trigger that you said, this boss offered you great money to go work for him, or what was there a particular trigger in your life that said, I'm going to go do this?
So working with a lot of brokers in the bank, you can see some really good ones and some really bad ones. And you're like, if that guy can do it, why can't I do it? And I was in my 20s, wanted to learn as much of the trade as possible, and the banks are best for it. Like, you get paid pretty well, you can get a bonus if you work hard, and just the right opportunity never came up. And then it did, and I shouldn't say this, but the bank screwed me on a bonus. I was number one performer for years, like by a mile.
Is that just at your branch, or is that
like nationally at St. George?
Really?
Yeah.
Jeez. Okay.
And the it's yearly discretionary bonuses. So
discretionary.
So after the Royal Commission, they stopped metric bonuses. So it used to be if you did X, you get X. Yeah. And now it's like
discretionary. Is that the
funds? And it gets paid to whoever. I shouldn't be saying this, but it's the truth. So I worked my ass off. I got a bonus. I know a lot of brokers, same type of thing have happened to them. They work their ass off. They get a little small bonus, and then they go, you know what, I'm going to become a broker. So that was kind of the
trigger
transition. But I was always wanting to do it. So it wasn't just like spur of the moment. It was a thing that I was just waiting for the right moment.
Okay, get your sort of learn on your training wheels during the banks, and,
Yeah.
and once you're confident, 6 years or six and a half years is a lot of time. So I feel like you're ready to go after then, right?
Yeah.
Okay, and then Blue Crane Capital, who you're working for now, is essentially private.
We're a boutique mortgage broking business or
Mhm.
finance broking business. So we 3 brokers, there's 10 of us. There's 3 brokers and support staff, residential and processing and settlements. We're all ex-business bankers, so we've all got residential, commercial, development and super fund experience. So we do anything property related. We can pretty much do, which is pretty good because some commercial brokerages just do commercial or development. Some resi only do resi. So we get referrals from commercial brokerages giving us resi, and we get resi brokers giving us commercial. So it's a good spread to be able to help. Most businesses are small businesses in Australia. They will have potentially a commercial property and a residential property. So
Yeah, okay. It's a good spread. It's good to have a spread across all of those topics. Now, talk to me about property. You got a pretty crazy, wild property story, and it's really interesting to dive into. So, I mean, we won't get into it because the purpose of today's podcast is talk about self-managed super funds, but sort of run us through at a high level your property journey, especially that accumulation phase, and then update us on the latest, which I almost fell off my seat when you told me and when you came in before. So, yeah, how does property come into it? When are you buying? What are you buying? And where did you get up to?
So I met my wife. She actually, her first commercial property. So her first property was a commercial property. Her dad found a deal with a guy he knew. He was going under in his business, and he got it for a steal. So, $420 he paid, and the guy bought it 10 years prior for $420. Now it's worth like 1.5.
Wow.
So that was really weird. Buying property first time commercial. Spent all my money, went on holidays, got married, and then I would see all my clients. Some of them, buying all these properties. I'm like, well, if they can do it, why can't I? And then I just went on. I bought a unit, and then instead of doing research and then buying a property, I bought a property. First, and then read all the books, did all this.
Yeah.
It was a good learning curve. And then from there, I was listening to all the podcasts, bought a house out west.
So your first commercial property was located where?
Preston,
Sydney, New South Wales. Yep. The unit you bought was off the plan?
Off the plan, Carring Bar.
Yeah.
We lived, it was a sick unit. We lived there. It was nice. It's really good. So it
was PPR?
Correct.
Okay. What are your thoughts on it as an investment?
My advice to people, it's not advice because I'm not qualified, but my 2 cents.
Your findings from your learnings in the field?
Most people's parents say, why don't you go buy a unit in your local suburb? That's what most parents say. My mum says it to my brother. It might be a good investment. It might not be a good investment. So you got to make sure that, we bought it as a principal place of residence, so it served 2 purposes. Mm-hmm. And as an investment, it was okay, but to go buy off the plan somewhere in a concrete jungle, and then buying that as an investment property, you could probably go interstate and get something better, a house.
Fair. Okay, so then you venture out to Southwest Sydney for another investment.
Yep, in Bradbury, I bought it from. The government. Was an ex-housing commission property.
Now this is funny because I was also looking in the same location at the same time, and were you going to, because when the government did a Bradbury, it's called the Bradbury and Edge renewal scheme, none of those could be sold private treaty. They all had to go to auction. So were you going to all those auctions with Harcourts?
I bought it at the first lot that they had. So I went. One day I said to my missus, let's just, because I saw some of my really sophisticated investors, I'd see on their tax returns all their asset and liability position, Bradbury. And I kept seeing Bradbury from some pretty good investors. And I'm like, what's this Bradbury place? Looked online, and then I saw that weekend coming some open homes. So we drove out, had a look. We looked at 6. We went to the auction, and then the first 3, they were the better ones. They went for way too high. Yeah. And then all the big spenders, they've bought. So then the last few properties, we ended up buying probably one of the better ones for probably 80 grand cheaper than the first few, and they're all much. They all look the same.
Yeah, they're all copy and paste.
Yeah.
How funny. I would have been at those same auctions because it was, I think it was Harcourts was selling a lot of the first couple, and it was in an auction room. It wasn't on site.
It was at the Campbelltown
RSL
Catholic
Club?
Centre
Catholic? Yeah. Small world. Okay. So you build up there and then you leverage and you go hard and quick.
Yeah, so that was 18, 19, and then my wife, she goes, you know what, you're spending too much time, you're a bit obsessed with this property thing. My parents, they're divorced and they had, a few properties, and that might have caused issues with their relationship. My wife's like, she cried and she goes, I don't want us just like, not wasting, but like exhausting all of our time on property stuff.
Mm-hmm.
So from all the podcasts I was listening to, I could see a few early day buyers agents. So I reached out to one, bought a property in Queensland, 19, and then 20 wanted to do the same thing. And then in 20 with COVID, it just went crazy. I found a banker at another bank. So I was at St. George. If you're a banker with a major bank, you can get 90% no LMI at your bank. But at CBA, you can also get that.
If you're a banker at another bank.
Yeah. So it's like, accountants, solicitors, doctors have those policies, but they accept bankers. So found this really good banker, and he just, anytime I wanted to buy something, he could just call him up. Yep, no worries. Yep, it will work. All done. And then
that's in 2020.
2020.
When did you start? When did you quit your bank job? 2021?
21, yeah.
21, okay.
Yeah.
Yep.
Was it 21? Yeah, 21.
Okay.
So bought all the way through 20.
How many? Tell the people.
It's about 8.
8 in 1 year?
Yeah.
Okay.
And then I think 21 I bought 2. So I bought one more in Queensland, and then we bought one in our super fund.
Yep.
And then after that what did we do? We bought one more commercial, and then that's it. So I think it worked out to be 14 properties, 16 tenants because we built 2 granny flats, and then had a baby, started as a broker, and then just sat and just let it do its thing.
For the last couple of years?
Yeah.
Yep.
And then last year, so my wife's always, every time we bought a property, she'd be like, when are we going to buy our principal place of residence? And then she started like throwing out ages, like, 30, I'm 35. So she was like, 35, and then, got to 36, 38. And then I was driving home one day. I remember this. I was driving home through Brighton Les Sands on the main road, and I just had this like, this moment. I thought, you know what, stuff it. I'm going to start selling. So before I spoke to my wife, I got a spreadsheet, started to do numbers and work out how much equity or cash or whatever I would need to do to buy a home. And then I was thinking, okay, I'll need to sell a few. But the first, 3/4 of the property portfolio, they were, I kept pulling equity out to buy the last few. So the last few were all at low LVR. So I was like, okay, if I sell the first, I'll get a bit of cash and clear some debt. But it's not,
But they're high leverage, so you wouldn't even get that much after selling costs.
And by the time I pay tax and do all that, selling costs, like, it's not really significant. And I still hold the debt on the other ones. And even though they're not trading profitable, they're positively geared, in reality, in a banking calculator, you add 3%, you discount some rent, it's hard to get a property.
They dilute out to
push your servicing up. So I thought, you know what, stuff it. Sold
them. So you, over a couple of years, you accumulate like 12, 14.
Yeah.
And then you sit on them for, 1.5, 2 years?
Yeah.
And then you go, nah, I'm selling.
Yeah. And it was like...
wild.
It was like... I wouldn't say I timed the market perfect. I just was lucky that I just went... In COVID, everyone's like, the world's ending. I thought, you know what, stuff it. Money's cheap. I'll just... you're buying regular houses. For 300 grand. Sold 11 of them, so I don't have any residential properties right this second. I've got 3 commercial, and I just sold them. And
then you to buy your PPR, and you've bought it.
So we were looking for a few months and we couldn't find anything. So then my wife's like, "What the hell did you sell all these properties for?"
Oh no, Jesus. Yeah. Okay, happy wife, happy life.
So,
God.
And then we were looking for a while, and like real estate agents thought we were like crazy. They're like, "What's your budget?" We'd say, $1.8 to $3 million, and they're like, "What? Like, what is that?" Like, and then we were looking for a while. We found this property. Where I live in the Shire, houses that are renovated, they go for a premium. But houses that are not renovated, there's less competition. So we found a house. We thought it was in a really good suburb. We thought it would be well over our budget. We started chatting to the agent. There's only one other interested party. And we went to the auction and we won. So we bought that in November and we settle next month.
And you're going to do a bit of reno, PPR and...
Yeah, well, it's old. Couples lived in there since the 70s. And
wow. How's the carpet?
No, the carpet and a few things have been changed, but I think there's a blue or pink bath, and it's very original. But it's in a good spot and it's got good bones, so there's opportunity to make money there, and it could be our more forever home rather than 5 years or 10 years.
Yeah, you got room to expand and grow the family.
For a long time, yeah.
Just
7 bedrooms.
7 bedrooms. Oh my God, jeez! I don't know what you. I know what you've got planning for 7 bedrooms. Jesus.
2 offices, toy room, bedrooms.
You probably got a spa. You got a room for every day of the week. Jesus. Just quickly, accumulating 8 to 10 properties in a year. Is that how are you doing that? Is that in personal name, and are you doing that with your own money, with work bonuses, with equity? Like, how did that? Because a lot of people would be thinking the same thing as me. Is that to accumulate 8 properties, really good that you don't have to pay LMI and only 10%. And if I know a lot of your purchases around that sort of 280 to 350 mark, so it's not a heap of money up front. Correct. But Tom said anything by 8 is a lot.
So every deal cost me about 50 grand to get into, except for the last one. I think it cost me about 80. It's a larger property, and I built a granny flat. But the unit I bought, it kept on valuing really favourable. So even though I sold it for 50 grand more than I bought it, I was getting valuations for $75,000 more than I sold it for. So I pulled that equity out of the unit, pulled equity out of Bradbury, bought the next one, and then bonus comes in, bit of savings. So I've got enough for 2-3 deposits, and then I go buy. I was actually in 2020, I was buying 2 properties at a time. So I'd buy 2, and then I'd wait and then revalue it, pull cash back out.
3 months later or something.
A bit of extra savings. Just kept scraping equity as much as I can from everything, and just kept going to the next one. When
you're pulling equity out, you can bring it back to a 90% LVR then? Yeah. Okay, geez, must be nice.
Yeah. So that's I was lucky I saved. The question regarding structures, it was all in personal name. But we structured in a way, the reason for that is the policy at where we could get 90% no LMI, it had to be in your personal name. So I was like, okay, I'd rather in a trust, but I'm saving, on 10 properties, couple percent LMI.
Yep.
So there's pros and cons. I had some in my name, some in my wife's for land tax purpose. So pros and cons.
Pros and cons. Okay, really interesting that. Well, that is a investing strategy in itself to leverage into as much resi as you can, and timing the market as you did in 2020, 2021. I know the sort of areas in amongst Queensland and Brizzy that you did buy that did spectacularly well, and you said some of them have doubled or grew 90% in value in just a few years. So extraordinary, and happy to. You should keep us updated with before and afters of the of the PPR. I'd love to see how that one turns out. So look, let's dive into it and buying in self-managed super funds. And you did as well at the back end of your journey. Was that a play because of borrowing capacity, or why did you decide?
No, not at all. Borrowing capacity was, I think, okay at that time. But being in the bank, seeing all my clients, and being in a business bank, I did a lot of commercial finance. So most of the super funds I did at the bank, probably 80% were commercial. So I saw my clients buying, commercial properties in their super fund. I actually set up a super fund 2016 online. So like trustdeeds.com, you can go set up a trust deed.
Yeah.
I didn't set up $800. I didn't do anything with it. And then
That's a self-managed super fund? Okay.
And then in 2020, I got my accountant to set it up, received a call from the ATO, and the ATO, I thought it was fraud. Some guy, calling up, leaving all these messages saying, we're auditing you. I'm like, why? And so because I had 2 super funds, me being young, just set it up online, never did anything, chucked it all in the cupboard and just left it. I don't know the laws, so disclaimer, everything I'm saying is just like my experience.
Yep.
But I don't think you're allowed 2 super funds. So we had to go through a massive audit before they could make my proper super fund compliant. So make sure that you're getting professional advice.
Of course. Look, I think anyone listening to this, it's good to say as well, not financial advice, but definitely speak to and pay for advice from an accountant. But Nick is on from a lending perspective around what's required to buying your self-managed super fund for getting that loan and getting into it. We'll also get an accountant on from an accountant's perspective. So you're obviously not going to be giving the accountant's advice, nor would the accountant give the lending advice. But okay, so you've seen a few clients doing mainly commercial?
So in the bank, a lot of commercial. Some resi, I was getting a lot of people buying off the plan. Units in Brisbane years ago, for some reason, there's a lot of them. But a lot of commercial. A self-employed person can buy a self-managed a property within their self-managed super fund, and their business can lease it off their self-managed super fund. So that's a benefit of self-managed super fund for self-employed clients.
Yep.
But for the average person, you can't buy a self-managed super fund and live in it or occupy it.
As your PPR. So if you're a business, let's slow that down. If you're a business owner, I can, provided I'll have, is there an amount of money in my self-managed super fund that, is a good working capital to start off with? Because obviously if someone's got $20,000 in their super fund, it's not going to be probably enough for the deposits and stuff, which we'll get into. But what's sort of like a starting capital for people to start thinking about this?
So there used to be limits, and wasn't like each lender had their own limits, like minimum requirements. So it used to be around 2 to 250. Some lenders have scrapped that now. You can do whatever. I've done super fund loans for buying a 250k
really
commercial property, a little shop. I think he put in 150, so he was under that 200k mark. I've had another client buy resi, 80% loan. I think it was a 350k purchase. So, that was only $100 and something thousand. So you can. There's no minimum. Some lenders do require you to have liquid funds remaining in the fund, so either in shares or cash. Sometimes they might. Some lenders have scrapped that, so they don't care. But they do expect you to have something left over to
after you make the purchase.
After you make the purchase, to cover any maintenance, accounting fees.
So there's just like a little buffer there.
Yeah.
What sort of deposits are needed and varying from lenders, say your major banks down to like your second or third tier? Is there differences in deposit that's needed?
So residential, it's 80% across the board. There are some lenders that will go above 80%. You pay a risk fee or you pay a higher rate.
Risk fee on top of LMI?
They call it a risk fee instead of LMI.
Okay.
It's just a different fee. It's pretty much the same, but I don't think it's insured. It's just you pay a premium to get a higher risk product. So.
Yeah, fair.
Don't see too many of those, but 80% is standard for residential. The major banks, they don't play in it anymore, so it's a lot of your second tier lenders. So, First Mac, Think Tank, Latrobe, Liberty. There's a few different other lenders that a lot of people would never even hear of. Commercial, you can get 80% as well. With residential, the pricing's pretty standard across the LVR. It's like the rates are, I think I'm doing one right now, it's mid-sevens for residential.
Yep.
So it's about 1% higher than interest-only investment loan that you would get from a major bank. You're looking at mid-sixes, so that's mid-sevens. Most people go down principal and interest. Some people choose interest only, but I typically see principal and interest.
Yep, that's so they have it paid off. That way you can pay it down.
Yeah.
So if you're doing interest only within your super, that would probably be why, because you want to buy more properties in in your super, would that be right?
So there's a few different. So the terms are 30 years. So the payments are stretched over, the 30-year period for commercial and residential. Mm-hmm. There's one or two lenders that do have offset, but sometimes they might not be the best lender for that client. They might not have at today's era, high interest rates, people want to borrow as much as they can. Mm-hmm. So there is no offset with some of these lenders who have better borrowing capacity. So there's no redraw. So if you get a 30-year P&I loan, you pay it down, mm-hmm. And then you throw in an extra $10,000, you can't get that back.
Okay.
If your property grows, you can't revalue the property and pull out equity like you can outside of super.
So once you've paid it off within your super, can you sell it though?
You can sell it.
You can sell the prop. Are you may or may not be a question for you or a accountant? Are you then liable if it's within your super to CGT and all that kind of stuff?
There is, yes, but it's at a discounted rate
within super.
I don't.
Okay.
For an accountant, but it's definitely the tax rate in super mm-hmm. is lower than outside of super within a company or personal names.
Okay, and the type of asset that majority or a lot of people are leaning towards is there any? Is it sort of more commercial, or you said that you've had off the plan units, you've had 300. Would you say it's varied, or you've seen any patterns with what people are buying within self-managed super funds?
It does vary. Some of the younger people trying to build an investment portfolio who've got less super, they're going into residential, and they might be buying a 300-400K property. Some of the theory behind that is hold it for a cycle or two, make some money, sell it, and then you've got a larger pool of cash in your super fund, and mm-hmm. then you could then maybe buy something bigger or go into commercial at that point.
But you can't, if you've got, say, like a 50% LVR, you can't draw that up to 80% within your super.
Correct.
And then buy another one.
Yeah, you can't do that.
Okay, so you've got to wait till you essentially want to sell it or pay it all the way down.
Correct. But if you pay it all the way down, you still can't get the money out. The only way to get the cash is by selling it.
So you would then just have a property that's paid off, that's renting at $700-800 a week going into your pocket for your super.
And that's with the offset. Some people, if they can get an offset, it works well. Mm-hmm. But some people choose interest only, or they still choose principal and interest, and instead of paying it down really quick, some people have got a 10-year payment strategy to pay it off. Mm-hmm. Some people no, I want to pay the bare minimum so I can build my fund up again to buy something else.
True. Okay, so that was going to be my next question. So all when my employer pays my super, that doesn't go straight to paying off the entire debt, right? That goes into my super, and then I can figure out what the repayments are that the bank says, and if I want to put any extra into it.
Correct. So when you get paid from your employer, mm-hmm. you get paid super. It usually gets paid into a retail super fund.
Yep.
If you've got a self-managed super fund, you can nominate it to get paid into the bank account of the self-managed super fund. Mm-hmm. So the self-managed super fund still works like a normal loan. There's a loan, and you'll need to have a bank account where the rent goes into and your super contributions
go into.
And then from there, you can build that bank account up, or you could diversify into other assets while you're building that up. But mainly, shares, or you can work with a professional to help you, get a return on your money. Mm-hmm. And then you can buy another property. At the moment, though, borrowing capacity, I don't see too many clients buying multi-million-dollar properties in super. Mm. You are limited by your borrowing capacity. So,
is your borrowing capacity calculated on your super repayments?
There's different ways to do it. So it's the standard way is your super contributions plus the rent. So if you're on PAYG, $100,000 a year, $10,000 super, they use that $10,000 plus the rent, and you can then put that into a calculator and then work.
You can pay 30. Oh, okay.
But there are other methods to improve borrowing capacity. So if there's more members in the fund, the more super contributions there are as well, which can increase the max borrowing capacity.
Mm-hmm. So like a husband and wife, right?
Husband and wife. There used to be 4 members per fund. Now you can have 6.
Okay.
I rarely see 6. I've seen 4. Like,
Is it just families? Like, I couldn't imagine you
Yeah.
doing that with anyone else.
mum and dad and, the kids that put all their money in, and they'll buy something.
Mm-hmm.
It's 4's not as common. 1 and 2's is a lot more common.
Yeah.
Most people set up a self-managed super fund today to buy tomorrow. They don't set it up 5 years ago, start adding additional super contributions, and then come and say, hey, I want to buy. So some lenders will look at the client's profile and say, okay, they're on X amount of money. They've got, and then we get their asset and liability position. They look at the asset and liability position, and then the client can say, my strategy moving forward is to contribute more super. So up to, some lenders allow you to up to 27,500.
Yep.
They can self-declare to say, moving forward, I will be contributing that amount.
27,500 on top of your 10%?
No, total amount.
Total. So your 10% of your salary, and then the difference between that and 27.
Yeah.
Okay. Interesting.
And that improves borrowing capacity. And, the client would need to do that. And, if they're on 50K a year salary and they'll say tomorrow that they're going to contribute 27,500, probably not likely. But most people in super, they are a little bit more experienced. They've either worked in the workforce and built up a large super balance, or they've been pumping money into super, or they've gone out and invested. They've hit their borrowing capacity outside, and they're like, I really want to buy a commercial property. They've got the property bug, and they just want to do something. They want to.
Does it matter if you've, as you just said, if you've maxed out your borrowing capacity, like buying in your name and all that kind of stuff, and then you go to buying in your super?
No. So if it's just a standard assessment where it's the 10% or up to say 27,500, it's an isolated assessment. They don't do a separate assessment. It's purely an isolated self-managed super fund assessment. So if the client then fixes their borrowing capacity somehow, if their rates go down or they sell something or their income goes up, the self-managed super fund also doesn't affect their
borrowing outside.
So it's
a separate entity.
Separate entity.
Okay, because I'm just thinking about it. Even if you earned, say, $500,000 a year, your super contribution would be only $50,000. So if the interest rates are 5%, $50,000 would be, you'd only be able to buy $1 million property.
Yeah, pretty much.
Okay.
So
majority of people have got heaps more money in their super, like hundreds of thousands to wipe off the debt.
Yeah.
Does it matter if that property, say if it's a blue chip property and it's $1 million or it's $2 million and it's negatively geared, which means the rent won't cover those repayments? Does then the bank work out, okay, with my super contribution, it covers the repayment, it's good to go?
The calculator works it all out. So
Yeah.
like the standard calculator, you put in the proposed loan,
Yep.
And you put in the actual interest rate. Then they'll add their buffers in the background. So for resi, it's 7s. For commercial, it's 8s.
Okay.
For standard LVRs, but once you get to 80, it's 9. So then they add a buffer, and then put the proposed rental income in, and then,
They had a buffer on 9%.
yeah.
Oh my God. Okay.
So I don't do too many. I've done quite a few, 80%, but I give the clients the option, and then they make a decision. Most people sit around 65 to 75% LVR on commercial, and 80 standard for residential.
Okay. And why would they do a lower LVR for commercial? Is that because it's more expensive?
It's in price tiers. So, for example, one lender, they're 8.09 for 65, 8.19 for 70, 8.34 for 75, and
Percent LVR?
9.03 for 80%. So
Okay, so there are people wanting to knock that down.
yeah, and so there's like the two opposite ends. There's the people that want to keep accumulating and pay the minimum monthly payment. They might want to borrow the maximum amount to keep their capital for the next one. Or there's some other people that just say, I want to pay it off in 10 years. So if they've got a large deposit and they can go I'm doing 2 at the moment. One guy, he initially wanted to do 65% LVR. Then he worked out his payment strategies. He wants to pay it off in 10 years. To get a better rate, he can pull back the LVR to 55. His payments will be less, and he was like, there's no point in borrowing more if I want to pay it off sooner and I've got the money. So he put a larger deposit down.
So he puts a larger deposit down. He has a lower interest rate on the loan. Is that commercial?
Yeah.
Okay, and then what's the end goal? Because the commercial, if it's what's the sort of price range we're talking about for commercial?
Varies,
Okay.
I've done stuff at 250, but it sits around between 5 and 1.5 is where I see a lot of clients buying.
Because there's not heaps. I feel like once you pay that off, like say a $2 million commercial property that's yielding 5%. Okay, it's a little like, do they get to? Is their plan when they pay that off is to keep the commercial asset and have that paying them rent, or to sell the commercial asset because then it's grown significantly in 10 years and then use that cash? What's the...
So a lot of people initially when they buy it, they look at the cash, but they can change their mind at any time.
Okay.
So like a lot of I've got clients who send me really comprehensive spreadsheets of 10-year payment plans and then how positive the property is and all the cash that they'll have from that over a 20-year period. So everyone's got, you could sell it. You could have a cycle and the property increases significantly and you might sell it. So
4 or 5 mil, or depending. Okay, so it's going to be up to different people's circumstances, I suppose. Do you have any key learnings or anything that you, in terms of in the self-managed super fund space, anything that you can share with the audience that was key learnings, or where to save money, or obviously one that you've said before is not to have more than one self-managed super fund, but is there anything else that you can share from your time on the ground and what you've seen across clients that you can share with the audience here?
Yeah, definitely. So get the advice first from an accountant. So a lot of people call me and say, I want to buy something in my self-managed super fund, and I'm like, have you set up a fund, or have you had a chat to anyone? And they're like, no. So I can always do the numbers for them to give them some like a guidance. There's no point in them going to spend $2,000, $3,000, $4,000, $5,000 setting up a self-managed super fund, and when they come to me, it doesn't work. So there is quite a process. So you need to get the advice, set up the super fund. That takes some time. You then need to set up a bank account. So then when you roll over your funds from your retail fund, it has
into the bank account.
Go.
Yep.
And then rolling over the funds from the retail fund can actually, I've seen it take up to 12 weeks.
Wow.
So I always say to clients, you need to tick those off before. You can't just go buy a property
and then try to do
and then try to do that in the background. And then in terms of the structure, so there's a self-managed super fund, and there is it's got a trustee. So it could be Wilcox Family Super Fund Proprietary Limited as trustee for the Wilcox Family Superannuation Fund. So that's the super fund. There's the Bear Trust. So the Bear Trust is a holding entity that holds the property while there's debt. So that has a trustee. So it could be Bear Trust Proprietary Limited as trustee for the Bear Trust. So good accountants would set up the Bear Trust for the Bear Trustee, or the company, prior to you buying a property, because on title, when you sign the contract, the Bear Trust goes on the contract. So a lot of people go out, they sign a contract, and they put the super fund on the super fund can't hold assets. Well, they can't hold the asset while there's a loan on it.
Okay.
So
is that how everyone buys in their self-managed super fund?
Yes.
Okay. Oh, so the self-managed super fund itself can't hold the property?
So it can when it's paid off. So when the property is paid off, it gets transferred to the super fund. But while there's debt, there's the Bear Trust. And in terms of putting it on the contract, you need to speak to your accountant, because each state has different rules and regulations on how they want that on the contract. So to avoid penalties or double stamp duty, always chat to a professional. So I get clients that come to me, and I always refer them back to whoever gave them the advice, just so they're getting it from someone, an accountant always would get updates, and if there's any changes, well, we help with the lending, not signing the contract. So once this is like to help the limited recourse. So when there's a loan on the property, the bare trust holds the the asset. The super fund borrows the money. The super fund receives the rent, and the super contributions pays the loan.
Yep.
If it all goes bad, only the bare trust that holds the property, the bank can come and take.
Yep.
They can't come after other assets within the self-managed super fund.
Okay,
So
interesting.
it's just a way that they've created it to enable lending within a self-managed super fund.
Okay, and it's sort of in case you have other assets or money as well within the self-managed super fund. Okay, so
You can have many things.
Yep.
You know, crypto shares,
All that
money,
stuff.
cash.
okay, so the bare trust is sort of like that one degree of separation in terms of that would be if you started defaulting on your loan or anything like that, then the bank would just come after the bare trust and take the property, right?
Correct. So for recovery, the bank can take. The bank can always take a property. They can't, like, if you stop paying the loan, you're not going to say, I own it in a super fund, you can't touch me. So this is from my understanding, after doing a lot of research and just doing it for many years. But I speak to a professional.
Yep.
But the bare trust protects the super fund.
Okay, that's a good little golden nugget. But of course, the disclaimer that I will put on the end of that is that Nick comes from a lending background. So the particular structure that he's talking about, you would need to double check with an accountant and get something that suits you. But I feel like, Travis, you got anything else you want to add? But you're fully across that as well. That was really good, Nick. I really appreciate it. So as a little bit of a wind up is that there is no minimum to buying your self-managed super fund. However, you will need between 20 to 30% deposit. Your borrowing capacity within a self-managed super fund is split and is different to your borrowing capacity outside of a self-managed super fund. So you can be capped outside and still be able to buy inside. How they work it out inside is the rent that they're going to receive from that property and the rental contributions that you can make. You can also increase your contributions to $27,500. So that on top of whatever your property is going to pay you in rent. There's no real do's and don'ts or properties to purchase. It's going to depend on your current circumstances, whether or not you're buying with the minimal amount of money possible and you want to grow assets within that self-managed super fund, or you want to use as big as deposit as possible because maybe you have a lot of money, a big chunk of money within your self-managed super fund. But also important to note is that to think about the game plan, because once you're paying down that loan, you cannot, even if you're buying at a 65% LVR, you can't then draw that back up to 80 to buy again within your self-managed super fund. You've got to use the money you're making contributions or sell the asset. Am I correct?
That's right.
Perfect.
You can refinance though, but you can't take cash out. So, for example, if you buy a property at 80%, this is commercial. So if you buy a property at 80%, you've paid some down. It might have gone up after a couple of years. You can and you've got an 80% rate. You can actually refinance that to another lender.
Yep.
And
at a different LVR rate.
At a different LVR rate. You can even extend the term. So rates are pretty high now. You might say, you know what, I want to extend the term from 25 to 30 years, get the better rate, and your cash flow would improve. You can increase the loan ever so slightly to cover costs. So like bank fees and all of that type of stuff. You just can't take physical cash out.
You can't take physical cash out to use for buying your jet skis and stuff like that. All right, perfect. Look, I think that's a really good summary in coverage. The next step would be for us to get an accountant on to talk about that side of the process. But look, Nick Wilcox, really appreciate you coming on and appreciate your time.
Thank you. Thanks for having me.